Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Donald Trump's sweeping tariffs kick in, including Chinese levies as high as 104%. Beijing weakens its currency. Chinese officials say they have the policy tools to fight. The sell-off resumes with stocks and futures sharply lower. 10- and 30-year Treasury yields soar. Investors talk of a fire sale in the bond market. And European leaders look to navigate the trade wars, with Italian leader Giorgia Meloni planning an EU-approved trip to Washington, while Spanish PM Sanchez urges better ties with Beijing ahead of his meeting with President Xi.
A lot to digest this morning. Let's get a quick check on these markets, because red on the screen, the selling continues in the equity market. At least that's what we're positioned for. Euro Stoxx 50 futures down a whopping 3.6%. Compound that with what you're seeing in the U.S. session. Futures down 2% on the other side of the pond as well. Even the 10-year seeing a massive sell-off, as Anna mentioned. 441 here. 48 hours ago, that number was 387. That's kind of volatility we're looking at, reflected in the currency space. And even Brent crude taking a hit, trading at $60 a barrel. At 55, American shale stops drilling. The countdown to the opening trade starts right now.
They don't want tariffs on themselves. And it's very simple. We're making deals, and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%.
Do you see the Declan Rice free kick last night? The golf starts tomorrow. I'm trying to find good news out there right now, because elsewhere news is fairly grim. Certainly the tariff story goes from bad to worse. You could argue 104% now being applied to China. Markets don't like it, Anna. And the news is fairly ugly.
Yeah, the news is fairly ugly. We'll come specifically to the way the market is pricing that in a moment. But recapping these headlines, we now have the worst offenders, in the words of President Trump, being tariffed. More than 100% tariff on Chinese goods, as he says, 104%. China is starting to fight back. We already saw the counter tariffs from the first round. They haven't struck back at this second round of tariffs just yet. But they are perhaps taking note of this as they fix their currency. Yep. It's weakened for the fifth day. President Trump has noticed. He says that they are manipulating their currency. Others call it managing the pace of decline. Bloomberg Economics says this takes 3% off the Chinese GDP. President Trump is signalling that there are deals to be done. Obviously not before the implementation of the tariffs, because we've seen that now. But there will be deals to come over the next few months. But they've got 70 or so to do, bespoke deals. That's going to take a lot of bandwidth from the White House and his team. And right now that's not cutting through with markets.
The good news, I think, perhaps you were looking for, is the White House has been touting these deals with South Korea and Japan as the closest ones to the finish line. But you are still not seeing much movement from the administration on China. And I think that's the one, to your point, that the markets care about more than all the other maybe 70 other deals that are being had. Because at the end of the day, if there's no budging from the administration, we haven't even seen any thawing in that. It's the one place where both Democrats and Republicans are united. It's the anti-China rhetoric. So is a deal even coming, or negotiations even on the table when it comes to China?
You've got the world's first and second biggest economies colliding at high speed at this point, and the economic fallout from that is going to be significant and is going to affect the rest of the world. I bring up the golf because I do wonder whether Donald Trump will be distracted by the Masters over the next few days.
Yes, relevant.
Maybe that could be something that we need to think about. Maybe there's a little hiatus as we watch what happens at Augusta. But the pharmaceutical story is on the table now as well. We've been waiting for this to come through. That could be something that shows up in European markets this morning
Absolutely,
too.
and I think that is really important, because I think that's a signal that President Trump, far from backing away, far from thinking about 90-day, pauses in any trade tariffs, which obviously was nonsense. Far from doing any of that, he is still thinking about more tariffs, more tariffs. Pharma is excluded from all of this up to this point, but he said yesterday that they are coming soon. They had been exempt, and the fact that we're seeing Asian pharmaceutical companies from Japan to Australia to South Korea, all of them trading down on the back of this.
Let's talk about these markets, because I'm still wrapping my head around the news, and I think the markets are selling first, thinking about the news later.
Which markets? I think we need to be specific about what is going on. So let's start and figure out exactly where we are. So yesterday, huge swing. in US equities. So we gapped higher initially and then we sold off aggressively. So Europe now has the mechanical gap to fill this morning. So we've got to fill that. So Europe looks like it's going to open lower. European equities are going to be opening lower this morning. But then you've also got to factor in the extra move that we're seeing on US futures this morning, which are also lower. So the US story is going to continue to the downside. Then we come to what is happening with the Treasury market and what is going on there, particularly at the long end. What is that signalling? Who is selling is one of the key questions that I'm trying to get to the bottom of right now. Is it EM central banks? What's going on with China? Who is selling in this market? Is it funds being forced to sell? I don't know, but clearly the cost of funding is going up. Is that an inflationary narrative we also need to factor into our thinking as well? Mary Daly sounds pretty confident at the moment that Fed policy is in the right place. Clearly the Fed is worried about that inflation story as well. But the steepening of the curve is aggressive, and it looks like it's going to be continuing. We've got 10s going out of the door today. We've got 30s going out of the door tomorrow. How will those auctions go? Yeah,
the steepening is happening. We're up 12% on the 12 basis points on the 30-year right now through the Japanese session, of course. But I would point out that we're actually seeing yields rise across the curve. Yes, more at the long end, and that's been the feature of the last couple of days. But new today seems to be the fact that the short end, we're also seeing yields go higher. That doesn't apply to all geographies, but it does apply to the United States, interestingly, and I wonder what that tells us about where this goes. And to your point about what's driving this, a lot of people talking about the basis trade. Is this to do with hedge funds? But is it also to do with a fundamental reassessment of fiscal imbalances and tax cuts to come?
Well, the fire sale, as Bank of America put it, yes, 100%. The liquidity story continues. We saw that early on in the high value equity names, the Nestle's of it all, the technologies of it all, and of course even the gold. You saw the margin call show up there. So there is that element that's starting to bleed through into the bond market. The currency market to me is really interesting because suddenly Japan and Switzerland have a currency problem that they now have to deal with. The central banks now have to deal with simply because of the massive haven flows that you were seeing there in terms of appreciation. On the other hand, oil is tanking. A 60 handle on Brent and still dropping. We're looking at a 3% margin drop here. In the first trade war, the average move for oil was about 4%. We're looking at 57 on NYMEX. At 55, American shale stops drilling. And I bring this up because Scott Bessent has very specifically said if there is good news in all of this is that Americans pay less at the pump because of these moves.
They want lower Treasury yields as well. They're not getting that. That is a big factor. Donald Trump is highly attuned, it seems, at the moment to the fact that he wants yields to go lower. That ain't happening, folks.
Yeah, and it's not happening at the short end either, which I think is a bit different today, isn't it? In the midst of all of this, we did mention, President Trump, we played that clip earlier on of him saying that countries are reaching out to do deals, to try and have talks with the United States, and we've got at least one European country trying to spearhead those talks then, Kriti.
Well, so Emmanuel Macron gave it a whirl, Keir Starmer gave it a whirl, and now it's Giorgia Meloni's turn. And she's someone who, of course, has been touted as a friend of Elon Musk, as a friend of the White House, someone who was invited to the Mar-a-Lago estate. At the same time, her Spanish counterpart looking eastward, looking at China. Pedro Sanchez saying, look, maybe the negotiations to be had are not with the United States. Maybe it's with China. It's a complete shift in narrative from two nations that have not necessarily always been the voice of Europe.
So here's an interesting one. Giorgia Meloni is going to be going to America, pushing for no tariffs on any industrial products between the United States and Europe. Now, this is something that Elon Musk has talked about. And so you wonder which voices in the White House are in the ascendancy. We've seen different White House voices going after each other on trade tariffs, Musk versus Navarro, for example. So I wonder whether Meloni, on her way to Washington, whether that kind of argument starts to gain.
But that's not Trump's problem. Trump thinks that the European Union has a VAT problem. Trump thinks that we have a technology regulation problem. He thinks there's all kinds of other issues. The tariffs are one issue, but it's not the only issue. So is that going to kind of hold any water at the White House? I wonder. Without the complete package, is Europe going to make any progress? Yeah, we'll get rid of industrial tariffs. Fantastic. Thank you very much indeed. But what about this other stuff? What are we going to do with that?
Well, they're not going to move on VAT.
Well, precisely.
No, I don't. I mean, lots of people we've talked to have said that no one in Europe is moving on VAT.
So how do you solve that one? And if you can't solve that one, can you solve the bigger problem? Is it about the detail here? It appears that the White House doesn't want to segment this. It has issues across the board with the EU.
Yes, absolutely. He thinks it was created to take on America, doesn't he? I also read that J.D. Vance is going to be in Rome over Easter weekend, and he doesn't tend to travel quietly, does he? We know this.
Yes, maybe he'll make some comments there as well. But this is a litmus test, isn't it? This is a litmus test that we've seen with Israel. It's kind of a litmus test we saw with South Korea and Japan, and now with Italy as this litmus test for how they're going to approach Europe as well. I wonder which ones the markets will respond to.
Yeah, but it's Italy It's the EU that has to do it.
This is sanctioned by the EU, yes.
I appreciate that, but she's going with an EU message. She's not going with an Italian message.
Yeah.
And I wonder how precisely. Let's talk about what we've got coming up on the show. The bond market absolutely front and centre right now. Marie-Anne Allier, Carmignac Fixed Income Fund Manager, joining us very shortly. Bilal Hafiz is going to be joining us from Macro Hive. Ursula Marchioni from BlackRock is going to be joining us a little bit later on as well. We've got some great guests lined up to analyse what is turning out to already be quite the markets day, Chrissy.
Plenty of markets day, plenty of data as well that we want to keep our eye on. We have some earnings as well over on the other side of the Atlantic, Delta and Constellation Brands. But I think the 10-year auction is maybe the highlight of the morning today at 6 p.m. UK time, simply because we've seen so much volatility, of course, in the back end of the curve, as Anna was talking about, but just even in the 10-year, 442 this morning. How digestible is that? Does that incentivize more people to hop in, capture that yield, or does it do the opposite? Does it actually say, well, the volatility here, we don't want to touch it? So that's going to be, speaking of litmus tests, a good one. Plus, an hour later, FOMC minutes. How on top of the news is the Federal Reserve? I guess we'll find out.
You know, that almost passed me by, the fact that we get Fed minutes from...
Does it even matter?
So far in the rearview mirror, so much has happened between the last meeting and now that I'm not sure how relevant that is going to be. I think the who is going to buy is a really key question at the moment. Is there fear that if you own treasuries, and there's some big treasury holders out there, China obviously one of them, am I going to get paid? I think that's a real question right now that people are beginning to think about. Are people going to step up to these auctions? And who, I think, is going to be critical. How much is going to be left? How big is the tail going to be? The tail was big yesterday, and I'm just wondering how big it could be today and tomorrow.
On the front end,
with the 10s and the 30-year. Yeah. But we get it. We're moving down the curve as the week progresses. What else do you need to know this, Wednesday morning? Germany's CDU, CSU Conservatives and the Social Democrats are moving closer to a coalition agreement to form the next government, with a potential announcement coming later today. A deal will pave the way for Friedrich Merz to take over as Chancellor of Germany. Key cabinet ministers are likely to be announced quickly after that news. The finance minister post likely coming or going to the SPD, the junior coalition partner. Boeing has logged its best delivery performance in more than a year, handing over 130 aircraft in the first quarter. When you hand over aircraft, you get paid. It comes as the US company works to improve its output and narrow the gap with Airbus. Boeing's rival out of Toulouse, scheduled to unveil its monthly orders and deliveries in just a few minutes' time, I think at 1:15. Both companies and their supply chains likely to be significantly affected by tariffs. And President Trump's tariffs are rattling US consumers, leading many to stock up on everything from cars to olive oil to iPhones. Sales have surged at Apple, Best Buy and European specialty stores, with customers buying pricier items to get ahead of potential tariff-fueled price increases. Car dealerships across America seeing significant pickup in interest. People are buying their iPhones. You break down an iPhone, not much of it comes from America.
iPhones, the car dealerships is the interesting one. How much is the markup from these dealers right now if everyone is front-running that?
Yeah, does that negate the saving?
Exactly.
I wonder.
Yeah, normally you'd get a deal. I'm fascinated to see what effect happens with second used cars going forward from here. They have held up in the past when you've seen these kind of crunches. It's been a big inflationary driver.
Yeah. Coming up then on the programme, US cybersecurity firm SailPoint CEO Mark McLean is in town. It joins us to talk tariffs, AI application and much more. What incredible time to take the business to the market or back into the market. Plus, we'll check on pharma stocks at the European market open after President Trump promised to announce more levies on that sector. That's supposed to be coming soon, according to the president. Up next, we'll get back to bonds with the US 10 and 30-year Treasury yields soaring. We'll stay across markets, of course. If you have any questions, if you want to get involved in any of these conversations around this desk, IB plus BBTV Go, please use that function on the Bloomberg terminal. This is Bloomberg.
We've got policy in a very good place right now. We cut the interest rate by 100 basis points last year. That puts policy in a good place to stay modestly restrictive, keep inflation coming down, but not so restrictive that the economy is vulnerable. So with growth good and policy in a good place, we've built the time and the ability to just tread slowly and tread carefully.
Slowly and carefully. Mary Daly, San Francisco's Mary Daly, talking about where the Fed is, where she is in terms of her thinking around what is happening to the US economy. The sell-off in Treasuries gathering pace, long-end yields rising the most. You got front-end yields up this morning, but it's the back end that really is moving, once again, with some significant speed. You are seeing significant selling pressure. Who is selling, I think, is a key question here. Is everybody selling? Are there key groups that are selling? Let's try and answer some of these questions. Valerie Teitel is here with more. Val.
Guy, I think the other part of that is there anyone buying? Is there anyone absorbing all of this selling? Because the market is telling us that we don't have the balance sheet availability to absorb this de-risking that's going on in the Treasury market. Because remember, Guy, if you are if you are a company under financial duress, or if you're an investor trying to de-risk, you de-risk your most liquid assets, hoping that there'll be a buyer for them and you can buffer cash on your balance sheet. But what the market is telling us overnight is there might not be that kind of balance sheet to absorb it. Take a look at the price action of the 30-year yield overnight. If we flip the board, they breached 5%, a rapid move higher in this yield. This is not something the Fed or any market participant wants to see. This is the world's most liquid market having some issues with price discovery. If we flip on, though, I want to talk about one more thing. It's this move in swap spreads, Guy. The 30-year swap spread had one of its biggest moves in history, frankly, yesterday. That is showing us that there is a lack of dealer balance sheet to absorb all of this liquidation in the Treasury market. And that is a key concern when we're very concerned at the moment about funding stress. We're watching cross-currency basis. We're watching overnight repo for any further signs that this funding stress, this stress in the Treasury market is eking into the overnight funding.
Valerie, thank you very much indeed. Yeah, we're going to watch this carefully. Marie-Anne Allier, fixed income fund manager at Carmiac, joins us now to carry on the conversation. Good morning. We're seeing some really big moves, particularly at the long end. Is this a temporary phenomenon? Is this a temporary strike, buyer strike that we are seeing? What is going on right now, do you think, at the long end, both in Europe and particularly over in the United States?
First of all, I just want to be sure that Trump is asleep right now and that he won't tweet just in the middle of the interview, because I could very easily look stupid. Having said that, I have... It's very difficult as of today to say what happens in the long end. It's very strange because the equity market, the credit market seems to say, OK, guys, we are heading into a recession. And so normally the long part of the curve should be, going down and not up at this speed. Having said that, who is selling? Probably you have some repatriation trades. Probably Japanese investors are going back in Japan. European investors are going back in Euro. You can see that a bit when you look at the forex market. The euro is appreciating, the yen is up as well. So maybe you have the kind of people, there is so much volatility, so much things that we don't know, that you prefer to be at home rather than being abroad. So you probably have these kind of things. You may have, some people are talking about Donald Trump. For example, you may have some, hedge fund deleveraging, but it's too soon to say, to be honest.
OK, so far so good. No social media posts to upset the apple cart while we're having this conversation. Given what you are saying, though, are treasuries, are fixed income assets a safe haven right now? They don't appear to be. And I'm wondering, therefore, what is a safe haven asset at the moment? Is cash the only safe haven asset out there right now? Because it doesn't look like fixed income is playing that role.
Yeah, I fully agree. The fact is that with all this tariff and the recession and all, everybody is looking for fiscal. We are looking for Chinese maybe to put a big fiscal boost. We are looking for European. Probably the the part of the European answer will be more fiscal. In the US, you will have probably more fiscal. And then it's not a good news for the long part of the curve. You know, the steepening was something that everybody was playing before. Because you will have probably more fiscal, it will be the easiest and the answer for a lot of countries. So the long part is not a safe haven, and the short part of the curve, the 2 years, let's say, looking at the US, the Fed, Powell was not in the hurry to say we will cut rates tomorrow. Dali, you just mentioned before, say, well, for the moment we are at the right place. So probably cash, and cash in your country, in your currency, is probably the best place to hide. Meaning that, you know, for a European issuer, cash in euro is better than cash in dollar, for sure.
Marianne, we're just getting the open of the European bond markets, and we see at the 10-year horizon, French bond yields up by 7 basis points, Spanish bond yields up by 9 basis points, Germany rising, but only by 3. What contagion should we see from what's going on in Treasuries into Europe?
Again, we will have the same kind of answer, more steepened curve, because, well, we will have to, we already saw that, you know, we had, before this tariff, we had the Merck's and the German U-turn on fiscal. So we know that we will have more issuance on the long part of the curve, long part meaning 10 to 15 to 20 years. And it will be the case in Germany, it will be the case in Spain, in France, maybe at the European level. So it's not only a question of contagion, it's also a question of the fact that you know, more issuance, more debt will be issued on this part of the curve, and so it deserves a quite higher yield. On top of that, you will have a competition around the world. You know, everybody will want to issue. Then you will have to offer more yield than the other issuers, and it will drive probably yields higher on the long part of the curve.
Marianne, can we talk about the other side of the Atlantic for a moment? I'm looking at a 10-year, a U.S. 10-year at 441 right now. 48 hours ago, that level was 387. We have a 10-year auction today in the States. From your perspective, do you hop into the U.S. bond market at these levels, or is volatility still a spook factor here?
I think volatility is still too high. Again, I don't think, well, unless, you know, the Fed came and say, okay, we re-engine a QE, which may be possible, you know, we don't know, but unless we have things like that, frankly, before buying, I will prefer to have, you know, a bit less volatility and to see, because 4% is not, you know, if you say 2% inflation, 2% growth for the US, which was you know what we were thinking, 4% for 10 years is not, you know, a level that is very, very high. So I won't say it's a screaming buy at this level, and I will probably wait and see before jumping in the market.
Marianne, just very briefly, do you see signs that China is selling its treasuries?
No, they don't, you know, say to the market that they are selling. So I'm not sure that we can. It's surely something that they are thinking of, but I can't say I'm seeing Chinese already selling. It will be, you know, a big retaliation tools for sure.
Well, we'll certainly see if that. If push comes to shove and we get to that moment. Marianne Allier, Fixed Income Fund Manager at Carmignac, we thank you so much. Coming up, we're going to continue our conversation about the choppy waters ahead, especially when it comes to U.S. firms operating primarily in Europe. Mark McLean of SailPoint joins us next. This is Bloomberg.
Welcome back. 30 minutes from the start of equity trading. Equity markets are focused as we see futures markets are considerably weaker. Some of that is just catching up with the US session of yesterday. Some of that is possibly dipping for another time because US futures are also weaker, down by 1.8% on E-minis, for example. But bond markets, Chrissy, also very much our focus this morning.
Very much. You are seeing a sell-off again. A lot of it may be a catch-up as well, or taking their lead from the United States. But take a look at this, a 12 basis point move in the Italian 10-year, the 10 basis point move in OATs. Germany still moving quite a bit. I think a 5-6 basis point move is pretty enormous there.
Absolutely. But this is not what's supposed to be happening in so many ways. Equities are down, obviously, and this changes the calculation in terms of the discount rate, in terms of where equities ultimately go, in terms of kind of where yields are priced right now. What are we hitting? What are we talking about? Which assets should we be watching this morning? Because there's been a few degrees of variation over the last few sessions as to which asset class is leading. Val's got her eye on this one. What are you watching?
The price action of the 30-year yield a few hours ago, it breached 5%.
Yep.
In, a matter of 30 minutes, a big slide. And I think this is probably the beginnings of a market dysfunction in the Treasury market. We only have to look back to March 2020. The real kicker was a failed Treasury auction, a 30-year bond auction, where there was no buyers. There was no balance sheet availability to take that down. I think we're seeing hints of that today. The 30-year swap spread had one of its biggest moves yesterday in history, and that is a very clear sign of balance sheet availability. That is telling you that we are seeing de-risking from many market participants, but there isn't the buyer on the other end to offer them that kind of liquidity. This chart on screen really showing you how pronounced the move has been in swap spreads of the last 3 days as we see yields continue to soar higher this morning.
Well, speaking of swap spreads and the credit crunch that we've been talking about in the last couple of days has been leading the market. You pointed out just a moment ago that the iTraxx is already tracking higher by 42 basis points this morning and climbing as we speak.
Yeah, this is the other thing to keep your eye on is any signs of a corporate credit crunch. And I think we're seeing a jittery open, at least for that today. If you look at iTraxx crossover, which is the high yield benchmark, it's opening up 44 basis points wider. That is worse than a few days ago when we gapped at the open. These are not kind of price action gaps you want to see. Prepare yourself for quite a jittery open for bank stocks in 30 minutes time.
Valerie, thank you very much. Bloomberg's Valerie Seisel with just some of the volatility that we're seeing in markets. With that in mind, what a time to bring a company to market. Security software company SailPoint Technologies re-entered the public market in February, raising $1.3 billion amidst a backdrop of tariff uncertainty and IPO malaise, trends which have only accelerated in the weeks since. The firm, which works with 51% of the Fortune 500, reported full-year earnings that were well received by analysts. Nevertheless, shares have slipped since the debut. SailPoint CEO and founder Mark McClain joins us now. Mark, welcome to the programme. It's a volatile day. I was going to say you picked a busy day to join us, but they're all busy these days. So thank you very much for being with us. I mean, as a CEO, you've brought the business back to the market, listed some of it at least, for another time. How do you manage to keep your head with all of this volatility? Is it easy to focus on the day-to-day?
I don't know that it's easy, but it's certainly required. I think the phrase we developed the first time we went public a number of years ago was every second you spend looking at the stock price, you're doing nothing to help the stock price, right? So let's stay focused on the business, on what we can control, customers and technology. And yeah, it's obviously been a pretty bumpy time in the market, but I like to say we didn't go public for what would happen in the first month or two. It's obviously a long range.
Yeah, and a lot of the market reaction around tariffs in the early days was around companies that produce goods, widgets and things that actually go from one place to another. Your business is obviously a services business, but there is now this concern perhaps that we see a ratchet up of tariffs from a European perspective onto US services firms. Is that something you're mindful of?
A little. I think, we're a very global business. We're a very industry distributed business. So we have a lot of ways to make sure we can kind of absorb things that happen. One of the interesting indicators for us is what happened during the pandemic, right? It was a similar vibe, as we say, in some ways, in that people kind of rocked back and were uncertain of what was happening. Fairly quickly, though, in that type of environment, customers tend to do what I always call a stack ranking. Like, well, if I'm not sure I have the capability to do everything that was in my plan, I'm going to stack rank. And I like to say people don't cut 10% off the side of everything. They cut the bottom 10% of their stack. And so what we're fortunate in, I think, is that in today's climate, what's clear is that cybersecurity is still a pretty high priority for almost all large enterprises around the world. And we sit in kind of this, what's now the center of that, called identity security, because what's true today is that while the bad actors around the world, from nation states to criminals, are still trying to break through the firewall, as it were, they're trying to compromise identities more than anything. They're trying to get accounts and passwords and then log into systems and just walk out with tons of data. And so if we can help protect that, I don't think that's going to diminish in any way in a difficult economic climate. As we all know, AI is blowing up, and we're seeing all kinds of non-human action in the world of work. And so I think we're trying to make sure we help our customers, which are, as you said, the largest corporations in the world, be prepared for that.
How are you, and before I actually ask this question, let me just mention that we do have headlines and reports, I should say, crossing the Bloomberg terminal right now, that China is planning on meeting on U.S. tariffs as early as today. So a dialogue perhaps maybe in the works between the two largest global economies. With that in mind, talk to us about your willingness or your even exposure to be to other regions outside of the United States. We know you operate quite heavily here in Europe. There's a question right now in this era of deglobalization why massive corporates, specifically American corporates, would even want exposure to Europe, China, Russia, if that rehabilitation comes to the fore?
It's a great question, Kriti. I think in general, we haven't been as focused on some of the most challenging markets, meaning things like Russia and China. We're very active across the European market, even much of Asia, although, again, not focused in China. And what we find is, especially in the industries we serve, we're very big in government, we're very big in financial services, we're very big in technology. Those are pretty global spaces still, even in the context of what's happening. I think tariffs may put some pressure on those industries, but I have to say, when you talk to a large global bank in Europe or in Asia, they reference U.S. and European large global banks. They think of themselves as part of a global market. So what's specifically happening in the U.S. and a lot of those markets doesn't really affect how they think day to day many times. So we're focused on these large corporations and government entities around the world that are absolutely focused on protecting their information, their data from attack, and that really we don't see changing in any way. Frankly, it's probably going to get more acute in a world of more technology access to information. How do we protect that data appropriately?
Are you sensing, you're ultimately an American company operating in Europe, as you point out. Are you seeing any hesitation or resistance from your customer base to lean in to that, given the geopolitical and the tensions between both sides of the Atlantic?
Honestly, part of the reason I'm over here is to check that out a little bit. I think our sense is that we aren't anticipating much of that. We've heard rumblings that European and Asian companies may be a little more on their heels with regard to American companies, with what's going on. I think our general sense is most technology people think of themselves as solving their problems, and they need the best solution to solve their problems. And so at the end of the day, I think they're not going to be unless they feel pressure from senior management of these organizations to back off of American companies. We aren't actually anticipating seeing much of that. Again, my sense is most business people in global businesses think of themselves as somewhat global citizens, and they sort of operate in that mindset of I need to do the best thing for my business as it operates around the world, get the best technology to solve the problems I see, and we aren't anticipating much of that. We'll keep an eye on it.
3 weeks ago, you'd have sat down there, we'd have led with a question on AI. That would have been the first thing we would have.
I would have much more preferred that,
I'm sure you'd be much more happy with that kind of
I'd love to comment on tariffs, but I'm really not an expert. So,
What's happening with AI as this all unfolds elsewhere?
I think it's interesting because that does get quite relevant to us because, as we have all seen, there's a lot of push from the mega vendors, the hyperscalers, as we call them, the Google, Amazon, Microsoft world, to push this technology. And you see it from the largest software vendors like Salesforce and ServiceNow leaning in on AI. What's starting to get talked about a bit is there's a little bit of a hesitancy sometimes in adoption from customers. What I think we're going to start helping people understand is some of that is due to what we focus on, which is as AI is starting to get used, we're seeing instances where the technology isn't that well controlled, and all of a sudden a prompt in AI will return information to that user who asked it to get information that they're not actually technically allowed to see. There was a famous tweet from Mark Benioff at Salesforce a few weeks ago where we love what Copilot is doing, except now I've learned that some of my employees are reading some of my emails. I'm not comfortable with that. So there's a sense of we want to adopt this technology, but we want to use it in a way that protects our information as well. There's an old saying in our security industry that why do race cars have brakes? So they can go fast, right? So you have to be able to brake effectively if you're going to go into a hard turn at speed. That sort of describes business today, right? We're trying to move at speed to get things done, but we need to be able to brake when we need to. And right now in AI, there's concern about our ability to control what information is getting accessed and returned to people.
Braking and AI both seem to involve an awful lot of heat.
Good catch.
What happens next in your world? You've gone back to the markets. You've got a load of big tech companies sitting on a lot of cash. Like Tom Bravo, obviously, is kind of where you are right now.
Right.
But do you see consolidation coming out of this? You've got a lot of cash-rich big tech companies. They've been spending a lot of money on AI, but prices of technology companies generally are falling around the world.
Right.
Does that produce some unexpected outcomes, do you think, as the price of technology on the equity market changes?
I think it depends on how permanent this is. I think what everyone's watching right now is how much of this is some sort of shock to the system from which we recover at some level relatively quickly. If we've taken a longer-term reset, and that looks fairly permanent, I think you will see activity kick up in M&A, because obviously at times when prices are depressed, those with a lot of cash can make some aggressive moves. I don't know that anybody yet is quite convinced how permanent some of what we see today is. So, for instance, as an owner, like in my case, Thoma Bravo, the private equity firm that still, while we're public, owns the majority of the business, they're not going to sell at a fire sale because they don't believe the business has fundamentally lost this kind of value. So I think everybody's going to watch and wait to see how permanent these changes are.
Great to see you. Thanks for talking about us.
Thank you.
Really
good to be with you all. Thank you.
Mark McLean, founder and CEO of SailPoint Technologies. Thank you very much indeed. Let's talk about these markets.
Yeah, let's linger on that just a little more, shall we? We have futures markets are pointing lower for Europe. We are expecting to see considerable weakness at the start of the European trading session. And that is, as Guy's been saying, a catch-up from yesterday on the US, where we saw an incredible range of movement, up by 4% at one point on the S&P, down by 1.4% by the close. So we are expecting to go lower in Europe as a result of that. So Stoxx 50 futures down by 3.7%. But there's a forward-looking element to this as well, because US futures are also weaker, and there's a lot of nervousness perhaps being generated by, in particular, the long end of the bond market, Chrissy.
Absolutely. Selloff in stocks, selloff in bonds as well. Let's go get a quick check on that, those numbers here, because you were seeing an 11 basis point move moving. I'm starting from the bottom up here in the Italian 10-year, similar move in the French 10-year as well. Panic is showing up in these markets. Relative stability in Germany, but even a 4 basis point move for the German Bund is not something to scoff at, Guy.
We're going to watch and see also what is happening with the pharma stocks this morning. You've seen significant selling already out in Asia of pharma stocks. President Trump weighing more levies on the sector. He's talked about it in the past. Remember that meeting with the RHT shock and the president in the United States only a few days back. We're going to focus on that area as well. Stocks to watch is coming. The market open is 17 minutes away. This is Bloomberg.
Welcome back. This is the opening trade. We are watching for that opening trade here in Europe, which could be a negative one. It will be a negative one, down by 3% or more on some of these indexes in Europe. That is the expectation. The futures suggesting we will be a lot weaker. US futures also weaker. Bond markets watching as long-end bond yields, in particular on Treasuries, but also to some degree here in Europe, go higher. What has caught Critty's eye? A bit of nervousness in credit markets, it would seem.
Absolutely, Anna, and that's really where we're seeing a lot of the pain. Already this morning, the credit spread index, the early indications of that surging as high as 43 basis points. So how does that translate to the equity market open we're going to get in just less than 15 minutes' time? I think this chart really shows that a lot of that pain could be concentrated in bank stocks. This is a correlation, by the way, that you are seeing between the European banks index and those credit spreads. So you can see going all the way back to the start of 2024, basically in a year's time, this is an index. These are two basically gauges that move inverse to each other. And the correlation is now at its highest in quite some time, an 85% inverse correlation, Guy, which really tells you that as credit spreads surge, the bank stocks get hit the hardest relative to some of the other indexes. But again, how many times have we talked about this on this show, that credit may be leading equities right now?
Absolutely. It feels like you've got a lot of cross-asset trades going on at the moment. Credit certainly in the mix. What's happening with those spreads? Fascinating. Ripping into a number of other different asset classes as we see those moves. Let's talk about the 30-year. What on earth is going on at the long end of the curve? Let's try and find out. We're joined now by Bloomberg Executive Editor for Asia Markets, Paul Dobson. Paul, what do you think? What's happening at the long end?
Yeah, morning, guys. So we obviously had another follow-through sale in longer-dated bonds, Treasuries in particular, but right across Japanese government bonds and Australia and New Zealand. As well in Asia hours today, a third day of declines in bond prices in a row, pushing those yields about 50 basis points higher at the back end of the yield curve. Real steeper moved and much more aggressive than we're used to seeing, particularly in Asian hours as well. There's a lot of theories. There's not a concrete piece of evidence that tells us exactly what it is, but lots of people speculating on different factors that could be contributing to this. A favoured among them seems to be banks liquidating their most fluid assets so that they can get cash to return to customers who need it, or investors needing it to meet margin calls. If you think about that, that might make most sense in the US hours, but the fact that the sell-off continues into Asia raises some question marks there. The second theory, it could be fears about inflation. The tariffs likely to be inflationary, particularly for the US. Big step up in prices. But again, there's problems with that because break-even spreads are actually much narrower now. The inflation expectations have been coming down, not rising, so some concerns about that one. What else could it be? It could be, a general boycott about US assets. Maybe investors don't like these tariffs and are finding ways to move into alternatives as well. You've got European and Japanese markets look a little bit more attractive, but then, like I said, the sell-off in Japanese assets too. Some people even saying, maybe this is a little bit of a warning shot from trade partners that don't like those tariffs. China could be liquidating assets, for example. The evidence for that is a little bit spurious at this moment, but that is one rumour that is starting to gain a little bit more traction and gain interest as well. And then there's the fear about the basis trade and whether that may be blowing up over time. And the more that we get these very sharp moves, the more that becomes a risk as well.
Yes, we had a list similar to that from a fixed income fund manager earlier on in the programme, and saying she didn't see any evidence of China moving yet, but it must be on their list, was the wording she had. What do you turn to in times like this then, Paul? I mean, the yen and certain currencies, not everything other than the dollar, but certain currencies getting some affection from markets as a haven.
Yeah, so it's fascinating because just when you need them most, some of these haven assets are starting to underperform, particularly the bond market. We haven't seen a great deal of gains for gold recently either. The yen and the Swiss franc both looking good, but they have their own problems. Swiss yields very low. You don't really want to be keeping your money there longer term. And the yen, has been a little bit all over the shop and buffeted by the volatility as well. So people definitely hunkering into the short end of yield curves, very short-term bonds, switching into cash where they can, and just holding money in reserve as a result. Looking for home markets and home bias as much as possible as well, and keeping their powder dry.
Absolutely. Paul Dobson, Boomer Executive Editor for Asia Markets, walking us through some of those early market moves this morning. We thank you so much. Let's go from the macro to the micro. Get your stocks to watch with Joe Easton. Joe.
Morning, Critty. So we've got to be watching the energy stocks again here in Europe after another big drop down in the crude price overnight. We're down to around $61 a barrel on Brent at the moment, down another 2.5%. And we've already seen big drops in these stocks. On just a one-week basis, we can see 15% to 20% declines in some of the big names in European energy, including BP, Shell, Total Energies and Eni. Just on a 5-day basis, already seen massive losses and set to extend this morning, given that slump in crude once again. Then I'm also watching the pharma space after Trump reiterates that we could potentially see tariffs coming in that sector very soon. Again, we don't really have much detail on what this will look like, but we have seen an impact across Asian drug makers. We've seen losses in drug makers in South Korea, in Tokyo, and also in China as well. Pretty significant declines across that sector today, so keep an eye on the big ones in Europe exposed to the US, in particular Astra, Roche, Sanofi. That 50% almost decline for Novo stands out for us on a one-year basis, but potentially more downside to come. Then one corporate story away from the pharma news is Peabody Energy potentially moving away from a deal to buy the coal-making steel business of Anglo-American. It's coal that is used to make steel. We saw Peabody Energy soaring on this news in the US. It was up around 15%. The reason they might step away is because there was recently a fire at the business over in Australia, which increases the risk. Analysts at JP Morgan are saying today that this could potentially be a material weight on Anglo's share price if this deal doesn't go through. So keep an eye on that one. Finally, in the ratings changes, we've got a couple of decent ones. The price targets in the investment banks cut at Morgan Stanley due to worries about the volatility on the investment banking businesses. And then we've got a downgrade for ITV at UBS. And Rolls-Royce gets another buy over at Kepler. Could potentially be a little positive for that one today.
Joe, thank you very much. Joe Easton, our equities reporter. Now, we've had a number of people talking about how the Fed can't necessarily come to the market's aid in this selling of all kinds of assets because of where it is on inflation or its fears around inflation. But other central banks maybe can step into the breach to the extent that that is possible. So traders are boosting Bank of England rate cut bets. They see a chance of a 50 basis point cut in May. Traders are fully pricing in an ECB rate cut in April. That's for the first time. So we are starting to see expectations build that we get more cutting here in Europe, at least.
It's easier to do it in Europe. You don't. The landscape is much more manageable from an ECB Bank of England point of view. It's slightly harder, I'd say, from a Bank of England point of view versus this is the ECB. It's really hard for the Fed. Can we navigate a financial crisis without the Fed kind of instantly being there? And this is what I think is making a lot of people nervous as we watch what Valerie says about the plumbing. How does the Fed manage that kind of whole process of liquidity going through the market at the moment?
And how does it set us apart from the COVID pandemic where the Fed was there?
Exactly. So this is, as you guys know, I haven't slept for like a week, and this is what I think about at night and trying to ponder it because I'm curious what happens. I'm taking the contrarian approach here. What's the worst case scenario? The Fed doesn't step in at all, which is what they're pricing in, right? There's no put.
Yeah.
What actually happens? Isn't it just a question of liquidity? Isn't it just a question of rebounding less quickly than we have in the past? Because one of the key pieces of the COVID pandemic or even post-GFC, where the Fed did step in to some degree, you just saw major recoveries happen way faster than history has suggested. The COVID recovery came back in 5 months.
It was instant.
It was very quick. The 2022 sell-off was a year.
But if there aren't those central bank backstops, does something break in the meantime?
29 to 32, market just goes down pretty much in a straight line. We bounce in 32, I think, 30. But yeah, what happens when you get pro-cyclical policies maybe being applied? I don't know. The market open is up next. 5 minutes to go. This is Bloomberg. Wednesday morning, good morning. The good news is the gold starts tomorrow. The bad news is you've still got to get through Wednesday. And judging by all the choppiness we've seen so far this week, could be a bit of a bumpy ride. Let's kind of mechanically work our way through the process we're about to go through. This is the European session yesterday. Climb, up towards session highs. We faded a little bit into the close. The problem with this chart here is that the blue line is the US session, the S&P. And as you can see, we basically go left to right in a downwards direction. We have to fill that gap this morning. That is something European futures are going to be signaling. Critical will have those in a moment. We've also got to add on to that this morning the fact that US futures are also lower. As you can see, this is a 2-day chart and we've been selling off. So the selling off has been continuing. We're kind of bumping along the bottom right now. Let me just show you the 1 day as well, just to give you maybe a cleaner read on what is happening there. So we are down this morning on US futures. So you've got to add that on to the gap effectively, Chrissy, that Europe has to fill. So there's the intraday on the S&P 500. We are down on E-minis by 1.6%. So you've got to add that on to what we saw yesterday out of the States.
Absolutely. A lot of pain already in futures, as you already said. 3.5% declines in Euro Stoxx 50 futures. The FTSE 100 down about 2%. But, Anna, the pain is in the best performer. DAX down by 3.3%.
Chrissy, let's have a look at some of the individual, I was going to say stocks, but mostly it's sectors because the whole market is on watch, I suppose, this morning. We are, of course, focusing on the pharma stocks. We heard from President Trump. He says a tariff is coming on that previously exempt sector. It's coming soon. Energy stocks in focus as we see oil prices, down by more than 2.3%. That's on both WTI and on Brent. Also keep an eye on Anglo-American. Plans to sell their steelmaking coal business could be questioned. Guy, what are we expecting at the open?
Down, I think. A lot of red. That's probably going to be the trade that we're going to be watching out for. Let me show you the opening trade. Here it comes. And it is expected to be reasonably ugly. You've got a gap to fill. You've got futures lower in the States. You've got what's happening in the bond market, all to factor in to this market this morning. The IBEX is out of the gate fairly quickly. We're down by 2.7%. The FTSE, I suspect, will continue to drop from that initial number. There you go. We're seeing some extra losses being piled on. The Stoxx 600 is down by 1.3%. These numbers are expected to get worse as we work our way through the opening few minutes. So there you go. The FTSE 100 now accelerating to the downside as we start to see a few more bids and offers being matched. I suspect a few more offers, more sellers than buyers maybe in the market this morning. So the IBEX is now down by nearly 3%. We're going to wait. We'll watch the CAC open. I suspect in a couple of seconds' time it may take the DAX a little while to get going. So in the meantime, Critty, what does the sector story look like?
I mean, pain across the screen. We're starting to see some of these trades shake out here, and not one stock in the green. It is a sell-off across the board, but a lot of it, at least in the early kind of point contribution side, is really isolated into the tech space and the commodity space. So if you're a heavyweight in Europe, you are getting hit. No surprise there. ASML is your biggest weight to the downside this morning. When it comes from a percentage basis, though, it is across the board. I'm waiting for a little bit of a better read, Anna, on the pharmaceutical stocks, but right now, red, red, red.
Yeah, absolutely. Basic resources and energy are the worst performing sectors, and this is all about global growth, isn't it? So basic resources, we saw the prices of some key metals being weaker through the Asia session, and so as a result of that, we no surprise that we see that particular sector go weaker. And energy stocks, of course, under pressure. Once again, we see weaker oil prices. We're at 61.22 on Brent, 57.90 on WTI. I mean, I pulled up the GMM screen, and apart from some currencies, pretty much everything looks red.
So normally on the right-hand side of my screen, I have lots of green. So that would be the up stocks, OK? There are no kind of stocks. There's just a lot of unchanged at the moment. So it's taking a while to get quite a lot of stocks open this morning in terms of the moves that we are. And there are a lot of them in terms that are not opening. As you say, the tech stocks and the pharma stocks are taking the hit. Roche is down. Astra's down pretty hard. Roche is down by nearly 5%. Astra out of London, that's a big weighting. I think it's the biggest weighting on the London market, down by 4%. But you've also got Shell down. You've got LVMH down. There's some real heavyweight names that are down this morning. But that's where the liquidity is. So you can open those stocks reasonably in a reasonably straightforward fashion. There's other stocks out there. I've got some upside. BAE Systems, Hensoldt are both higher. So you've got two defence names.
Spot the trend.
That are maybe seeing a little bit of a bid coming through this morning.
Does that set us up for some buying the dip in the DAX then, as we wait for the DAX to open and to shake out? Do we start to see that bid that we're seeing in the defence sector, or at least a tiny bit in the
Bright
defense
Metal
sector?
is up by 0.1%.
Well, there you go.
And we're still waiting for an opening price. You mentioned the DAX, Critty. Opening in Paris also not happening just yet. So waiting for the Paris market to open up. It's worth checking in on what's going on in gilt markets as well, just because we've been talking about the global bond market story to such a degree and the extent to which we're seeing long-end yields on the rise. Well, the same does apply in the UK. We've seen it come through into Europe about half an hour ago, and in the UK it applies. We're up on the 50-year, which is the longest, up by 13 basis points. At the 10-year, we're up by 7.8.
Bright Metal is the only stock in the DAX that is higher this morning. Everything else is down. Everything else is down. Sartorius is the biggest loss that we are seeing. It's down by 5%. So the DAX is opened. It's down by 2.7%. Call it 2.7%.
US Futures, actually, pulling back quite a lot from their earlier losses. Just sort of throw that in there as a slightly brighter note. We'll see how long it takes for that to filter through into European markets.
Absolutely. Briefly turned positive there. You are now looking at, well, 5,006 on S&P Futures.
That is a fast move.
Very fast move, but paired back really, really quickly. What does that tell you about liquidity around the open as well? I just want to quickly get a quick check on some of these bank stocks as well, because you are seeing a lot of pain. Financials this morning are taking a beating, down about 2.3%, so perhaps getting their cue from that credit crunch that our very own Valerie Titel flagged earlier. Let's get a little bit more context here. Bilal Hafiz, CEO of Macrohive, joins us around the table. Do you buy at this level?
No.
Buy what?
Well, one question is what do you buy? But at these levels, I wouldn't buy. I think this is the beginning of a much larger crisis, a regime change in markets, and this is much more of a bear market, and so it's more a question of selling any rallies rather than buying any dips.
What does that mean in terms of going back to the default outperformers? So this morning, for example, we saw that immediately the very sparse green that we got was in those defense stocks, which has been the outperformer of the first quarter. What does it tell you about the reaction function of where safety is in this market?
I think this is one of the big questions, because the normal dynamic is that markets, investors go into treasuries, the sort of defensive stocks, the dollar and so on. That's all changing right now. So I would change all my assumptions about what the safe haven markets are right now, because in essence, the set of policies that Trump has unleashed is essentially forcing a change in all of these relationships. So I think the new relationships are going to be in play. It's much more akin to the 1970s than it is to what we've seen over the last 20 years.
I'm slightly distracted, Bilal. It's very nice to see you this morning by the fact that we saw this big spike up in US futures and now they're dropping again. I'm just trying to find the reason for it, but I think it speaks to the volatility that we're seeing in markets and our reaction function at the moment. We got some lines out of China saying that they urged dialogue with the United States to resolve trade disputes from the Xinhua news agency. Perhaps that was sort of risk on, but then that was quickly followed by some other lines that suggested they have lots of countermeasures they can bring in and will take steps to defend their rights. I mean, what can draw a line in the sand here? Clearly, it's not necessarily these lines from China just yet, but what can draw a line in the sand if we're not going to see a backing down from the Trump administration? Yeah,
I think the most obvious thing in my eyes would be if Congress was to reassert control of tariffs. Congress delegated control of tariffs back in the 70s to the executive, and if they pull that back, that could be the most
and I did read that there's some talk about trying to do that from some quarters, but the percentage of the Republicans that they would need to make that happen sounded as if that would be a barrier.
Exactly, so that will take time, and that's what makes this current crisis much more difficult to see the end game for. Normally, the Fed would step in and bail everyone out, but it can't happen in the same way this time because inflation expectations are unanchored or becoming unanchored. Yields are rising, so the Fed is stuck between its inflation mandate and its growth mandate. So the Fed can't necessarily come in to protect markets. So instead, we'll have to be trying to go to the root of the issue here, which is the uncertainty over US trade policy and how to reassert some stability in that. And that's only Congress is the only one that could do that.
You're talking about a congressional put, which is interesting because at the same time, in the last 24 hours, we've heard reports that Republicans are also considering, or at least have been talked to with the Trump administration, about tax cuts not being put on the wealthiest class as well. Does this market, if it doesn't have a Fed put, need tax cuts to rescue the pain that we're seeing?
I think that wouldn't be enough, because the issue at the moment now is that if the market is worried about a fiscal issue on the US, then that could exacerbate the challenges for the bond market. And for me, the bond market is key here. If bond yields continue to go up, that will crush the US economy as a whole. And so the question then is, what policies could the US do to bring yields down? So far, what the market's saying is, dovishness by the Fed isn't enough, because the curve's steepening so much. So something has to sort of bring down the long end somehow, and tax cuts will, if anything, exacerbate the problem.
What about the UK economy? What about the Italian economy? Yields are rising in some key areas in Europe as well, at an alarming speed.
Yeah, I think it's not great for any economy in the world right now. What we're seeing at the moment is a global recessionary force, a global inflationary shock. And given market volatility right now, people are exiting the most illiquid markets. So that would include gilts, that would include BTPs. People would more prefer bonds over BTP. So everyone is going to suffer in this environment.
I come back to the question of what's safe. What is safe right now?
I think the few things that are safe, one would be gold. I think would do very well in this environment.
But doesn't it always get sold really quickly? When you have to sell, people sell the stuff they can sell, and gold is usually fairly near the top of the list.
Well, I mean, at the moment, there's a lot of other assets that they're willing to sell right now, because gold has still performed relatively well. And I think one needs to think of the scenarios that we're likely to see. So whether it's a bond crisis, inflation crisis, all of these scenarios, gold will generally do quite well. So I would say gold is one. Then on the FX side, I think certain currencies will do well. Euro, the Swiss franc, the Japanese yen, current account surplus currencies, which have been big buyers of US assets. So as they repatriate,
include the euro in that list?
I'd include the euro as well. Europe does have lots of problems, but they run a large current account surplus, which obviously Trump is not happy about. They've been massive buyers of European assets, equities, bonds. So as they repatriate, then that will provide support for the euro.
We're all at the coalface of every day of what's happening at markets because it changes. You have to be so engaged minute by minute with what's happening. But taking a step back, Bilal, you mentioned in your notes that we're moving from a rules-based global order to a personality-led global order. Do you think that we, markets, investors, really understand the magnitude of what is happening right now?
I don't think they do. I mean, I think people are just so used to the dynamic of markets for the last 30, 40 years. They aren't quite recognizing what we're seeing right now. When I speak to clients, investors, many of them wanted to buy the bounce on Friday, thinking there's a reversal coming, everyone's going to back down, the Fed's going to come in. That's not happening. This is something fundamental that's shifting here. So we've had this kind of rules-based system, which ironically is really
Where does that take us? What paradigm are we moving into? Do we yet understand what the paradigm looks like that we need to be investing in for the future? You're meant to look forward to invest. what am I going forward into? What is the paradigm?
Yeah, no, that's a great question, and that's the hard question that we have to answer right now. I think the paradigm we're moving into is one which will be more deglobalized. I think one also where we could start to see less cross-border capital flows.
Yeah.
So going back to an environment where you had much more nationalistic policies, both on the trade side and the capital flow side, to protect sort of industry. So we're moving to a multipolar world, less free movement of goods, and also, more importantly, less free movement of capital as well. That's the new paradigm we're moving into. But the ideal scenario even for that environment is you need rules for that environment as well. But the transition, if it's personality-led, will be extremely chaotic and challenging.
Yes, I was reading one of our columnists writing last night, Matt Levine, writing about how, where this but Bilal, this is also fascinating. It's made me lose my train of thought. You take us on, Chrissy.
Well, let's talk about the Federal Reserve, because I think
it'll come back to me.
We'll circle back to
There's a lot going on in Anna's head right now, too.
I mean, to be fair, in everyone's head. So I think the feeling is mutual. I'm really curious about the Fed, because we keep talking about the lack of a Fed put here. We keep talking about why Jay Powell isn't being more direct about perhaps the Fed coming to these markets' rescue. Let me ask you, what happens if they don't? What happens to the markets if there is no Fed put? Isn't and I'll give you my theory here, which is, doesn't the worst that happens is just that the market takes longer to recover? Assuming that nothing in the system breaks, it just means that the recovery is longer. Is that the worst case scenario for a lack of a Fed put?
I think that if the Fed doesn't come in, the question also is, how would the Fed come in? One way it could come in is cutting interest rates, which would provide some stimulus to the economy. The other would be to introduce some facilities to try to bring down Treasury yields. So they could try to introduce some facilities to improve liquidity in the Treasury market, have some backdoor ways of doing QE. So it sort of depends. They have an array of tools they could use. But let's say they don't do any of those things. I think that would then lead to much higher probability of sustained periods of volatility, higher probability of some kind of banking or financial crisis of some kind, as you get more defaults, as there's more higher volatility and VAR shocks across the system. So it's more discontinuous. I wouldn't necessarily see it as one way it will just slow things down. I would rather see it as something where there's a higher probability of tail events occurring.
Sorry, go ahead.
I've remembered my thought.
Go ahead.
The regionalisation of capital flows. It was linked to that.
Yeah.
It was the fact that if China can't export so much stuff, then the US can't export so much finance. And
exactly, yeah. Because the flip side of what Trump is trying to do, which is he's basically saying, I want to reduce the US current account deficit. What that also means is the US wants to attract less capital, which then means that everyone keeps capital, in their own countries invested sort of domestically. And there's different ways of doing that. But one would be the Chinese will say to their, and the Japanese will say, OK, all the companies that are investing abroad invest domestically now. And if you don't, we're going to start to take measures, have higher capital charges for you who invest abroad. And same with the US. I mean, Steve Moran in the US has talked about imposing a tax on foreign holders of US Treasuries, or forcing them to pay some, pay some charge for US public goods and so on. So
that's quite the world we're talking about. And it feels like that's a long way away. So maybe a kind of quite the journey to get there. Bilal, nice to see you. Thank you very much indeed, as always, for coming to see us. Bilal Hafiz, CEO of Macro Hive. Thank you very much. OK, let's talk about where the Core 6 looks like this morning. I'd pause before I bring you this board. It's ugly. Pharma's definitely taking the hit this morning, so Nova's down pretty hard this morning, but it's across the board. It's interesting that tech actually in some ways isn't seeing the hit that maybe some of the other sectors are seeing. But it's the right-hand side of that board you want to watch. Nestle, in theory, a safe story in Switzerland, down by 1.9% this morning. What else is going on? Joe Easton, what do you got?
So as you say, Guy, we are seeing losses pretty much across any sector. We could have picked pretty much all of the sectors today to see losses, but one sector really hit hard is energy. We are seeing drops down in BP, Shell, Total Energies, Eni. Now remember, as we said earlier, these stocks already down almost 20% on a 5-day basis, but the oil price coming down once again, hitting these stocks. Oil was down to around $61 on the barrel, so extending these losses, and some of the heaviest weights across the European market today coming from energy. Then Pharma as well. Guy mentioned the drop down in Novo, but we're seeing the peers declining as well. AstraZeneca here in London, Sanofi in Paris, Roche over in Switzerland, all of them dropping as Trump once again says that we could soon see tariffs on pharma, something that we haven't had details on but has been speculated. So pharma leading losses in the markets today, but chips are down, shipping down, pretty much everything is down at the moment. Then in terms of miners, that story on Anglo-American, potentially this one is just dropping with the broader mining sector today. But remember, Peabody Energy saying that it could potentially pull out of a $3.8 billion deal to buy the steel-making coal business of Anglo-American due to a fire over in Australia, and that was priced in as a boost for Anglo, so therefore we're seeing some of that retracing. But as I say, potentially a hit from the tariff issue as well. Then in terms of UK doctors' surgeries, GP surgery, something we don't look at too much. Assura, though, getting its takeover bid coming in, and that stock rising. We have had a few bits of news out of that one, but we have got more news on the offer price coming through, and we're seeing Assura gaining, giving us a green stock, not too many to pick from here in the UK or across Europe, so a little bit of positivity, but probably the only one we're going to have. In terms of the rating changes, ITV was one of the worst performers across the Stoxx 600. UBS cutting to sell. Two things going on this. One is the slowdown in ad spending due to the decline in the economy, and also streaming competition for ITVX, all those ITV crime dramas facing competition. And finally, Rolls-Royce is up to buy at Kepler Chevrolet. Kepler says that the company is potentially a haven from the tariffs. Their margins won't be impacted by US tariffs, according to Kepler, and they reckon you should be buying the dip. But no one really taking much notice of that today, because Rolls-Royce down 0.8% with the rest of the market, but Kepler Chevrolet buy on Rolls-Royce this morning.
Joe, thank you very much. Joe Easton from our equities team. US futures once again trying to move higher, it seems. Nasdaq futures have made it up 0.3%. I don't know if it was the China news that caused that spike up, but it popped up and then back down again, didn't it? We also have a little bit of relief. I am really clutching at straws here. But we had seen iTraxx crossover, so that measure of risk for corporate debt. We'd seen that for the high yield end up by 40 basis points, hadn't we, when we talked earlier with Valerie? Now it's only, in inverted commas, up by 22.
I mean, we'll take a win where we can get it, right? But to your point, there is that cross-asset move that perhaps not as bad is still something to be looking at. But you can tell, even from this market, you pull up an intraday of that futures picture, people are trying to find a reason to buy. They are, to your point, also clutching at straws, I think.
Do you think that people are looking for reasons to buy this morning?
Where else do you sell, and how far do you sell? Is that, I mean, we're talking about liquidation. We're now 3 days into it, and every tiny piece of news that we get, you see things tick higher. So I think there's maybe not a fundamental reason.
Is it the algos doing this? Is it humans doing this? I don't know.
True,
I think there's a lot of different factors and forces coming through in this market. It doesn't feel... This feels like a very nervous market still to
Maybe
me.
the algos struggle to process the conversation we were just having with Bilal Hafiz about the new world order that we're going into. You know, if the algos are basing all of this on the world order we've come from, what do they know about the future?
The future's really difficult, and I think this is... And also, how you treat different things. How would the market react to a emergency Fed rate cut? Would that be perceived as being negative because it tells us something?
I was just thinking that earlier. How soon before we start talking about emergency meetings by central banks? Yes, exactly, or other actors.
How would that be taken? Would that be taken as a negative? I think that's a key question. I was talking to Michael Masika about this yesterday. Would that be taken as a negative by the market?
Signalling,
If the Fed cuts rates at this point, how does the long end react? Would that be perceived as a negative for the long end and actually yields go high? There's all kinds of really difficult permutations that I think the market is struggling to understand at the moment.
But for that reason, I think that's why the fundamentals aren't driving this market. Like, I think people are having that conversation, but tick by tick, I think it's just a matter of finding a bid and making any tiny trades that you can.
Coming up on the programme, 20% tariffs go into force on imports from the European Union. We're live in Brussels with the latest reaction. That is coming up next. This is Bloomberg. Good morning.
I say that advisedly. We have equity markets that are down pretty sharply. You are seeing US futures bouncing around all over the place. European equities, though, are kind of playing catch up to the downdraft we saw yesterday, so you've got to factor that in. So kind of that's there. And then you get the bumpiness in the futures, which you've got to kind of think about maybe for the rest of the session. Bond markets are all over the place as well. What comes next, I think, is the key question. We're beginning to get kind of an understanding of the fact that China wants to fight. How does Europe react? Playing it very cannily at the moment. We've got, obviously, an early set of tariffs that are coming through. That's just a marker, it feels like, in terms of where we go next. Ollie Crook joins us now from Brussels to give us a sense of the picture from there.
Yeah, Guy, I think it's just a moment here to mark the moment that we're experiencing. We're talking about the trade from the EU, that 20% tariff now in place. There's about 500 billion euros worth of goods that go from Europe to the United States. 20% on that is 100 billion worth of euros that somebody's got to pay for. It's going to be the producers on this side. It's going to be the consumer on that other side. And who is going to pay that is happening right now. That is being determined as we speak. And for the Europeans, they need to determine how to respond. What we are going to get a little bit later today is the list of retaliatory tariffs, Guy. Not to the tariffs that were imposed today by the United States, but by those that were imposed a few weeks ago on steel and aluminum. That is going to be fairly limited. That's going to target only about $20 billion worth of goods. And this is all part of the EU strategy. They want to leave maximum runway open to have negotiations with the United States. What we will get, though, next week is when they start to build the architecture of what the actual full retaliation could look like. That is when we start to talk about targeting U.S. services, targeting U.S. tech companies, not just with taxes, but possibly also with regulations, and that is what we throw into next week.
Give us the likelihood of a deal here, Ollie.
That's not a, yeah, I'm not sure I can give you that. I asked all the trade ministers a couple of days ago, because they have Plan A and Plan B, what the likelihood of Plan B retaliation is going to be. No one is really willing to give an answer on that. What we do know is that Giorgia Meloni will be heading to Washington, D.C. a little bit later next week. She will be talking to Donald Trump. She will be serving as a sort of emissary to try to get some concessions from the Trump administration. But if that meeting with Benjamin Netanyahu is anything to go by, that is going to be a very tough discussion. We should also mention that right now, as we speak, Pedro Sanchez is in Vietnam. He touches down in Beijing on Friday. There has been a lot of conversation coming from the Spanish side about potentially reevaluating the European relationship with China. China, for its part, trying to cast itself as a much more reliable partner. The ministers I have spoken to, they are not ready to sort of rethink the relationship with China just yet. But in an era where the sort of unthinkable comes to bear, it is a conversation that we're going to have to be paying close attention to.
Oliver Crook, thank you very much. That's the European side of things. Let's get back into the market action. A huge amount of volatility in US futures. Valerie's back with us. What's driving this?
Look, I think what we saw, the positive reaction to those China headlines is the market is just really desperate for some good news. It's almost wanting to cling to the best news it can see, because those China headlines that crossed, there were some fair few negative ones, but we flipped into the positive on the one positive that they are, that the Chinese officials are resolving to. I don't know what's driving that, but but I think the price action we also saw a few days ago, just on some random posts on Twitter, is just showing you how desperate the market is to want good news. It really wants good news, and I think if we do get any solid good news today, we could see quite a decent equity market rally.
In terms of what comes next, therefore, what are we watching for? The 10-year auction today, what are the catalysts that we're watching for today?
The 10-year auction is going to be a big one. I think there is a big question out there about balance sheet availability, given the blowout and swap spreads. The 10-year auction is going to be a good test for that, even the 30-year, the day after. Yep. I would be watching swap spreads as well as a measure of just how able are market participants to access liquidity, because you need that dealer balance sheet in order to take that down and offer that.
Yes, I was just looking at the wording of that headline that says that sent the US futures, to your point about what algos do with it. It included the word dialogue. I don't know whether that is a word that AIs might associate with risk on in this strange world we now inhabit. Valerie Tytel, thank you very much for bringing us that on the volatility in these markets. US futures are pretty flat right now. European stocks are anything but. We're down by 2.7% on the Stoxx 600. We'll come back with more on the markets shortly. This is Bloomberg.
This is the opening trade. We're at 30 minutes into today's session. Red across the screen, some margins of green here and there. You really have to dig for it to see where there is some positivity. Briefly in defense, briefly in the futures picture, a market that is desperate to buy this morning. But broadly, you are seeing pain to the tune of 2 to 3% across the European benchmarks. We are still awaiting, of course, some news potentially when it comes to the pharmaceutical sector. And perhaps that's where a lot of the pain is concentrated this morning. Novo Nordisk is, I think, a great example of that, down about 5.5%. AstraZeneca right on its heels of about 6% there, Anna. So it's continuing to see quite a bit of pain.
Yeah, absolutely. Some of these European equity markets, I know, losing all of their year-to-date gains, which is quite a big deal when you consider how much we rose on the back of the defence spend, infrastructure spend impulse out of Germany. Let's return to the tariff news flow as President Trump pushes ahead with 104% tariffs on China. There are concerns over what industries could be hit next. I'm joined now by Brendan Murray, who leads our global trade coverage. Brendan, very good to have you with us on this very busy day. What's been the impact of these tariffs then? We're in, I don't know what round we are, multiple rounds, depends how far you go back.
This is round 3 or 4, depending how you're counting it. There were 2 rounds of 10, then the 34 reciprocal, and the 50 extra that President Trump laid out just a few days ago. So we're at 104%. That will trigger what a lot of people talk about is a decoupling. The Trump administration in the past has talked about strategic decoupling from China, the sort of slower pace, not on a big scale, but 104% tariffs will do a lot of damage to that trading relationship that's worth $500–600 billion. So we're waiting to see China's response. They haven't retaliated as of yet. In the past, they like to retaliate right before the U.S. financial markets open for maximum impact. So we've got some time yet before that happens, but China will respond. It's just a matter of how large and how cleverly they would.
So you're expecting more counter tariffs from China?
You would imagine that tariffs
or just domestic support for their economy.
It could be a package of things like tariffs or export controls where they would really hit the U.S. hard, would be in critical minerals and things like that. They could target American companies that are based in China. So there's a whole range of things that they could do. Chances are they'll pick a basket of things to strike back with.
So you kind of hinted at the pharmaceutical piece there. The markets are certainly pricing in. I'm curious, though, does that mean that, are you seeing any evidence of people pausing shipments? Are people doing that yet?
Yeah, well, we've seen some evidence. So American importers have spent the past couple of months anticipating today. They have front-loaded a lot of orders. The ports have been running at capacity for 2 months now. The question now is, what do you do? Your warehouse is full. You're looking at tariffs that are sky high. A lot of people would say, just wait this out. This will blow over in a few months, and don't pay that extra tariff if you can afford to wait. The question is, are those tariffs coming down anytime soon? It doesn't sound like the U.S. and China are close to talking at this point. So we're looking at a scenario where inbound cargo into the U.S. basically freezes. The Port of Long Beach CEO talked to Bloomberg TV yesterday and said we could crash 20% in the second half, given the volumes that we've seen build up, and heading into the second half. If the U.S. economy is in or near recession, those could come crashing back down. He said 20% they could fall.
Wow.
And that's it. That would have happened. Some of that would have happened even if we hadn't seen the tariffs imposed then, because of all that pulling forward of the shipments.
Exactly.
Yeah.
Now, some of that trade will be rerouted, and it won't disappear. But there is definitely a sense that things could, in terms of demand for overseas goods, could come to a halt.
It's going to be interesting to watch the ISM and the PMI data, just to give us a kind of clue as to what is maybe happening with some of that inventory story. Brendan, thank you very much indeed. Nice to see you, as ever. Brendan Murray, leading our trade coverage. Let's carry on the conversation about how this all impacts markets. BlackRock's Ursula Marchioni, who is the EMEA head of investments and portfolio solutions, joining us around the table. What's the conversation at BlackRock right now? What are you guys talking about?
Good morning. Paradoxically, we all focus on uncertainty and volatility, but there is one thing that is very clear at the moment, and it's the fact that many of our clients' portfolios haven't quite transitioned and embraced the fact that we've entered a new phase.
Yep.
If I look at March, exchange-traded product flows still very much risk-on, despite the fact that the S&P peaked on the 19th of Feb. So we had quite a bit of signals coming through. And so, again, 150 billion coming in, 112 in equities, of that 53 in US. I think it's time now to move to the next stage. We held one of our client calls on Monday and surveyed 1,500 clients, European clients, around what are you doing? And 50% of them said, well, we're waiting for more news to come. I think the time to act is now. We need to address...
What is ACT looking like?
Absolutely.
What do you do?
What do you do? Couple of things. One big bucket around managing drawdowns. Anna, to your point, we're looking at having erased everything that we've done in European equities, which was a huge component for our clients given home biases. We need to handle that. And so ideas there for equity exposures, thinking about minimum volatility strategies, quality factor exposures. Yep. Another idea is to look at portfolio from a total return perspective. So high income strategies focusing on basket of stocks that have good high dividends, potentially coupled with called over.
Are those dividends safe? How much reliability do I have on those kinds of factors right now?
I agree that the earnings season kicking off on Friday, if that's where you're going, is going to be pivotal because we still have good consensus estimates. US 7-8%, Europe is at 3%, but again, what I will be watching is the forward guidance in terms of how tariffs and everything that we are discussing is transmitting through. But definitely the drawdown space, for me, is a massive priority.
Do you think, Anna, we're going to get guidance?
Well, we live in hope. we need hope. We need hope. I want to ask you about the... So that's sort of in the moment, and you're saying, time for action is now. What assumptions are you making that underpin that around growth? I mean, lots of people factoring in weaker growth expectations. That's no secret. But what about inflation? We had a conversation earlier this week with PGIM, who talked about actually a lot of the inflation impulse staying in the States and other geographies at least being much less impacted. Do you think that's going to be a concern here in Europe as well? Do we need to worry about inflation, or we just worry about growth?
Look, tariffs will be stagflationary, and given that we don't have clarity about the duration of this negotiation, neither the magnitude of how the transmission will happen across the world, I think we do need to worry in general in terms of looking at how the picture is going to unfold. I guess taking a step back in terms of, the growth inflation balance, I can tell you for sure, Anna, that I haven't seen in, a long time the level of requests from clients to test their portfolio under a 1974 stagflation scenario. So you can see that people are starting to think about those components. And again, that's where gold, we've seen a lot happening, both in terms of flows and in terms of price. But again, strategically, it has a place in a portfolio. It's a good, it's delivered over the last 18 months in terms of geopolitical diversification. A second big component is liquid alternative strategies. So I'm seeing a lot of demand, particularly around absolute return systematic strategies where, again, people are trying to lock in streams of returns that are based on something else than beta. So that's definitely another element. Another area where we see a lot of demand is the short end of linkers in the US. And in general, if I go back to equities, a lot of attention to selectivity. So I did mention earlier taking down risk through mean vol and quality, but there's also a lot to be said around opportunities in specific areas, geographies, sectors. Think about European banks. We're seeing indiscriminate selling, to your point earlier, but profitability is excellent. And so, again, why can't we think about that? Or UK, where there's a very low exposure towards global trade.
Well, Guy was asking whether we can rely on dividends. I guess I would ask, can we rely on the profitability of banks if corporates are going to get into distress? Do you see that distress we're seeing signalled by some of the iTraxx crossover, iTraxx Europe? Do you see that having an impact on banks in the end, undermining that sector?
Yeah, no, and that's a fair question. But I think that from a European bank's perspective, a lot of the risks from a macro perspective have been hedged. And again, the path forward for the ECB is supportive. And so I would feel that that is a space whereby, obviously, the level of volatility and uncertainty will require to be nimble, to be granular in portfolios. But if I have to pick an area, that's certainly one.
You talk about this desire for liquidity. We're seeing it quite literally everywhere. What is the tell for you that there isn't enough liquidity or that there is structural stress in the plumbing?
That's a very good question. We've been watching relentlessly. There's nothing critical coming through yet. So if I look, for example, at Monday in the US, we hit the all-time high in terms of ETFs trading 40% of the overall tape. The average year-to-date was at 28%. Everything is behaving orderly in a normal manner. In Europe, we're seeing volumes around 1.5 to 2 ADVs. And this applies across asset classes. So I'm using ETFs as a vehicle because, again, you can, through a proxy, look into fixed income and equities as underlined. So for now, the message is stay invested and stay calm. But I do agree we live in very, very unusual times. And so being alert is the mantra.
So I'll ask the opposite question then, in that you mentioned the ETF story. Our colleagues over at Bloomberg Intelligence, James Seffart and Eric Balchunas, posted a chart yesterday. I'm kicking myself for not having it with me right now, but basically showed the use of ETFs in terms of some of these market trades that you're referencing. That kind of usage that hasn't come to the fruition since 2008. They're calling it a signal of capitulation. Are you seeing that in the market?
No, I don't think we are there yet. In terms of, client demand, areas where attention is going, just to give you another element, on Monday we saw 19 billion going into the S&P. So again, I think there's a lot of noise that we need to cut through, going back to the mantra of managing drawdowns, selecting, pockets where value can be found, thinking about recession scenarios and how do we hedge those tails that have become fatter.
Are we moving into a world, just going to think of your world, where capital stays at home? And what does that mean for BlackRock in Europe? What does that mean for your funds in Europe? What does that mean for European equities? An awful lot of European money currently lives in America. Is that money going to come home, and is it going to stay at home? Are we going to end up with a more balanced world? And what does that mean in terms of the gap between US equities and European equities, global equities, rest of the world equities going forward from here?
That's a very good question. So when I talk to our pension fund clients and our wealth clients, so say the large private and retail banks, everybody is crystal clear around their job, which is to deliver to the end investor, being a pension scheme member or an end retail client. Delivering to an end investor, if you keep that as a North Star, means acting across the globe, across asset classes, across regions, to the best interest of that end investor. So for me, look, there's a lot of uncertainty, and I do agree that we've entered into a new phase, but at the same time I have hope, and to your point, that North Star will prevail. Opportunities are aplenty.
Are you signalling that money stays in America? If the North Star is returns on investment, is the best investment still going to come from America going forward, or is it going to be a more balanced picture?
So my point was, I think clients will continue to act on a whole portfolio basis and assess opportunities. So there won't be barriers. The opportunities will be assessed at the whole portfolio. But to your point, look, do I believe in a 12-month period the US will regain its leadership? Yes. AI, there's like big transformative mega forces there. We are going through a very specific phase where, as previously mentioned, I think there's a need to manage drawdowns. There are pockets of diversification opportunities, European banks, we in an example, where some diversification out of the US, where so much has been done throughout Q4, is a good way forward.
Nice to see you. Thank you very much for coming to see us. Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions, joining us from BlackRock.
Coming up on the programme, emerging market assets have slumped as Trump's tariffs continue to upend global markets. Carlos Carranza from Allianz Global Investors joins us with the EM perspective. That's next. This is Bloomberg. Welcome back to the opening trade, 8:48 here in London, and the London market is down by 1.9%. The CAC and the DAX both down by 1.8% or so. So pretty heavy selling across European equity markets. But if we look ahead, US futures do point higher. E-minis now up by 0.4%. There's been a huge amount of volatility there. We've seen reports earlier on this morning. Well, we've seen news flow coming through from China, but we've also seen reports about meetings that are taking place in China. So we'll watch for any retaliation, further retaliation from China. China is guiding the yuan weaker at a carefully orchestrated pace as the central bank seeks to blunt some of the economic impact of the trade war without destabilizing financial markets. That would be the rationale. Let's discuss all that and other emerging market themes with Carlos Carranza, Portfolio Manager for Emerging Markets Debt at Allianz Global Investors. Carlos, nice to have you with us. Let's start with China then. There's a slow and steady, slight devaluation of the currency. Is that what we're seeing here? And what other tools would you expect China to employ?
The first one is definitely allowing the currency to devalue, increasing what they call the crawling peg of the currency. So basically, it's a very controlled, very gradual devaluation, but they increase the pace on a daily basis of that. If the market gets too uneasy, they slow down the pace. If the market is a bit relaxed, they accelerate the pace. But definitely, I think that the first tool for fighting against these trade wars is allowing a weaker currency gradually. And that is, I think it's definitely happening.
What's the big worry when you talk to all of your clients? I mean, I've read conflicting things about emerging markets. Depends on the asset class, depends on your currency, depends on a whole lot of things at this point. But in terms of debt markets, emerging market debt markets, some people are talking about this as an incredible haven in a sea of volatility elsewhere, and others are just nervous about all EM assets. So what are the conversations like, big picture, that you're having?
Risk number one is U.S. deceleration, undoubtedly, right? U.S. deceleration and U.S. inflation are clearly one of the drivers of the main concern, because generally emerging markets tend to be a beta to whatever happens in developed markets. So if you see this huge amount of volatility in developed markets, naturally that translates into risks into emerging market, right? So now, interestingly, there are winners and losers of these recent announcements, right? The implications of tariffs are very different across emerging markets, right? Regionally, some regions like the Latin American region are favored by this, relatively speaking. I mean, nobody's favored by this in net, but relatively speaking, there are winners and losers. Latin region, for example, Mexico is not subject to this. The Central America and Caribbean, they have a trade deficit versus the U.S., which means zero tariffs. And then Latin America has low trading balance with the US, and Brazil runs its own show. So basically, that's one region that wins. The region that is out of favor the most is the Asian region, which goes back to your point about devaluing currencies in Asia. Why is that? Well, very high tariff rates, very high tariff levels, and open economies which are small and very dependent on exports to the US. So that's the question number one. Clients are asking us, okay, so in emerging markets, where are the pockets of value? And then we go to the differentiation.
Okay, so it's identifying those.
Yeah.
Kristalina Georgieva, a couple years ago, had said that we were at a risk in the emerging market world of a real sovereign debt crisis. That hasn't really manifested, and a lot of that was at its core because of the inflationary pressures and the commodity pressures at the time 2021, 2022. Are we circling back there?
Short answer, no. We're not, because emerging markets is in a much stronger position to face what's happening. For example, central bank reserves in EM are up. EM GDP growth is not slowing down as much as US GDP growth. So this is a US-centered slowdown. Whereas in COVID, for example, it was the world. In this case, it's a US self-inflicted policy slowdown, which is larger in the US than in EM. And the third point is that if you look at balance of payment dynamics, and many countries in EM that already defaulted and they're no longer at default risks, that put the asset class in a stronger position. The same way, China, this time, seems in a stronger position to fight this trade war than in 2018 to 2020, which was, let's call it trade war 1.0. This time it's in a stronger position to push back, which is why I believe some kind of retaliation of any form might be coming.
So let's focus in on Latin America for a moment, because a lot of the outperformance is driven by the reshoring in anticipation of Donald Trump. In Mexico, for example, a rise of the middle class. How sustainable is that, though, if you're looking for a lot of that manufacturing growth that has been concentrated in Latin America, in theory, to shift to the United States, hypothetically, in the next couple of years in response to these kind of measures? Is that the Achilles heel of the outperformance and that stability you're referencing in the region?
Here's an interesting point, right? The trade war seems mostly focused on Asia, and already some Asian businessmen are discussing potentially transitioning into Central America, which has a trade deficit against the U.S., so U.S. exports more than import, as a way to consider planning for being smart about how they manage these tariffs, right? So, if anything, you could argue that some industries in Central America or Latin America go to the U.S., but at the same time you have other worldwide big production centers moving into Central America or even into Mexico because they're still under USMCA, right? So keep in mind that these announcements, Mexico and Canada are out of it, right? So because they have USMCA. And USMCA was actually negotiated by Trump.
Yeah.
Before Trump, it was NAFTA, the North America Trade Agreement, right? So it is Trump's creation, this USMCA, which might be why also the incentive to keep it running is different than from others, right? So it is a risk. It's definitely a risk.
Yeah.
But keep in mind that relatively speaking, if you have Asian corporations considering businesses in Central America, then that offsets the Central American businesses into the U.S., right? So, yeah.
And we've seen evidence of that in the Panama Canal, for example. China, of course, having quite a presence in the area.
And who's there right now? Yeah, the Americans trying to make their presence felt. A couple of headlines in the South China Morning Post this morning, one of which is China prepared to strike back. That's going out of state media. How quickly does that happen? The second one is China's looking to strengthen strategic ties with neighbours, according to Xi Jinping. Yeah. What does that look like? How far could that go? How friendly will China be in terms of what it can offer to some of its closest neighbours right now? So are we going to see a reordering of trade in Asia?
So right now China is in a stronger position because the entire world believes that the way the U.S. is managing this trade war is a bit unfair. There's a huge pushback against the way the tariffs were calculated, so the famous formula of imports minus exports divided by imports. Huge backlash against that. So China is not perceived right now as the one generating all this noise and the one driving global distribution, right? So that puts them in a more solid position to find partners, to find neighbors. Now, the real issue is, politically, that makes sense, but economically, the other economies in Asia don't have really the demand power for Chinese products that the U.S. has, right? So U.S. is a society where consumption is really, really high. And you really don't have on those Asian partners the ability to sell those products because there's no demand. I mean, GDP-wise, it's much smaller.
Right, so one doesn't compensate for the other.
Yeah, exactly. So I think that politically they are in good terms and they're definitely looking for partners everywhere, even in Europe, probably. But then it comes to the economics around it, and that's the real challenge, right? So because we may build strong relationships, but the business side of it, it's much more challenging given GDP sizes.
Carlos Gracie. Thanks for stopping by to see us. Carlos Carranza, Portfolio Manager of Emerging Market Debt at Allianz Global Investors. Markets moving pretty fast.
Yeah, futures are up again. We're on high alert, I think, for anything coming out of China. Carlos has mentioned it. We talked to Brendan Murray earlier on trade. He was talking about it, just how China retaliates here, supports its economy, retaliates against the United States. All of that in the mix.
There's a huge spread emerging between Italy and Germany this morning. German debt, 10-year, down. Italian debt up, the spread widening in Europe. We're not talking anything like kind of the crises we've seen in the past, but it's kind of worth keeping an eye on to see what is happening there.
Spread widening, that's not being reflected in the currency market. We're looking at a 110 at euro dollar. That does it for the opening trade. The Pulse is up next. This is Bloomberg.